What's the Risk? Hosted by myself, Daniel Crowe, and Peter Mancell, founder of Mancell Financial Group, a financial advice business he founded in 1980. This is a simple video series we hope investors can use to better understand index and portfolio performance, along with addressing some investment questions and dilemmas. This episode is on the MSCI Japan Index with net divs reinvested in Japanese yen. And we've picked this one for a specific reason due to the well-known underperformance of the Japanese stock market for a very long period. Your Investment Philosophy, book we wrote, available at Amazon. Disclaimer, please pause and read. Suffice to say our intent is educational and not rendering financial advice. Don't make us tap to sign. These are simple concepts we'd like investors to better understand risk so they can make informed decisions. Periodic performance. If you start from the left, things are looking pretty good, and then they start to drop away there a little bit. And once you hit 30 years, it's a bit gee whiz. And when there's arguments against indexing, the Japanese one will often come up. But in some senses, I think it's just risk because returns are not always going to be favourable.
Absolutely. And I can remember, Daniel, having come into the profession back in 1980. From 1980 through till about 1990, the Japanese stock market was probably one of the best performing markets in the developed world. Now, that was a 10-year period that sits 10 years after the start of this data series that you've got up on the page. But then from 30 years ago, around 30-ish years ago, around 1990, the Japanese stock market underperformed dreadfully for about 20 years. Now, back in the period from 1980 to 1990, which is part of my professional career, it was well known that there was an awful lot of collaboration between Japanese companies that would buy each other's stock. And looking back, it's been identified that probably falsely underpinned the Japanese stock market for a considerable period of time. But eventually, the lack of performance from those companies, actually in an economic sense and in a financial sense, meant that those positions ended up being unwound, and the stock market in Japan lagged for lack of investor support for basically a 20-year period, which goes from, on this chart, effectively from the 30-year mark through to the 10-year mark. And then more recently, the Japanese market has performed much more like the broader global stock market.
And you can see that period of stagnation in the growth of wealth chart, and it's probably another good reminder you're not owed a return just because you're in stocks.
Yeah, I think a couple of points I'd make. Firstly, you're absolutely right. Just because you take a risk doesn't mean you have to get rewarded. I recall vividly a conversation with Professor Ken French from Dartmouth College in the United States, who made the point that if you can diversify away a risk, then you don't have to be rewarded for taking it. And this is a great example because investing solely in Japan is an example of not diversifying. The second point that I'd make is you'll notice that the Japanese stock market from December 87, just after the 1987 stock market crash, doesn't start to fall until about the end of 1989. And for that 2 years, I think that the point I mentioned before about Japanese companies collaborating to hold stock price values actually underpinned the Japanese market in a very flawed way. And what we then got was the 87 crash in Japan. It just happened 2 and a bit years later. And then it bumped along the bottom for 20 years. We've seen in recent times, in the last decade, a very healthy gain again. But it just shows that any one developed stock market can perform very poorly over long periods of time. If we want to look at the other side of the ledger, and I haven't done this, but I'm sure we could go trawling through the data and find a developed world stock market which has been the shining light over that same period. They're just two ends of the same risk continuum. And if one diversifies across all of the developed world countries and emerging markets and the like, you will not have to put up with being overly invested into one market that turns out to be the lemon.
Second, growth of wealth. And for some context, I've added the MSCI World ex Japan. So you can see that the massive run up there in Japanese stocks was quite extreme in comparison to what was happening in the rest of the world. And I guess the second point is there are other places to invest, because there was a 3.2% per annum 30-year return we saw on a previous slide, but if you combine both of these in a 50-50 portfolio, that 30-year return becomes a 6.6 per annum return over 30 years.
Diversification, as Harry Markowitz said in his Nobel Prize winning works, it's an investor's best friend.
And range of returns. So not often you'll see a negative 20-year return, but Japan would have given you one if you'd solely been invested there. It also had negative 30-year returns, and in total there are 15 of those in the data, with the worst being negative 0.53% per annum.
That's reality. It's just an indicator that when we consider stock markets as a mechanism for investing, there will always be the worst market to invest in over any period of time. Just the same as if you look at a football league table, there will be the team that gets the wooden spoon this year. There will be the team with the worst record over 3 years and 5 years and 10 and 20 and 30. Those things, though, eventually turn. But certainly the period from 1990 through until 2010, it was a shocking underperformer. The flip side of that was from 1970 to 1990, it was the standout performer.
Rolling annual returns, and this is interesting. Can you see there's been a lot of strong periods north of the line over the years? They're up to over 40%, 50%, but they've regularly been counteracted by sell-offs that have continually kept the index down during that flat period.
I think that the chart is absolutely symbolic of the first 20 years, the Japanese market being sustained at values in what I believe to have been a flawed way. Then that had to be unwound. And it took 20 years for reality to genuinely be found by investors more broadly. And then the last 10 years, it's been pretty normal again. And if you go back to the left in that early period, 73, 74, there's a substantial decline. And that was the OPEC oil crisis.
Historic chance of a positive or negative. If you're seeing a 30% chance of a negative return over 10 years, you're probably going to be struggling with your performance.
I think that it's fair to say if one diversifies broadly, this doesn't become an issue that you have to deal with, because I would bet pounds to peanuts that we could find another significant developed market which would have almost no negative 10-year results. And you blend them together and suddenly you get a much more tolerable outcome.
Yeah, the ASX has not seen a negative 10 years since 1980. No.
My belief is that it's either zero or it's a very low proportion.
The largest fall in time to recovery just shows it was a consistent theme of going nowhere for a long time.
And if you look at the period that we've got in review here, it's 34 years, and there is 27 years of time that elapses where it takes you to catch back up the value of your original investment. But that makes sense when you've got a 20-year block in the middle where it just goes nowhere. This is just a depiction of the random chance of having picked the lemon.
Risk return or efficient frontier. So Japan, slightly higher volatility than global stocks ex-Japan, but as we know, much lower return.
Yeah, and if we drew this chart differently and found the best performing country over that same period, its dot, let's call it a yellow dot, would be above the World ex Japan Index and maybe slightly to the right. And that's what investors can take heart from, that when they do broadly diversify, there will be those other countries that don't underperform like Japan did at that particular juncture that will support their returns, that they'll get to enjoy.
And sources and descriptions of data. Thanks for your time.
Okay, cool.